Hello, everyone, and thank you all for joining us during the Lytham Partners Fall 2023 Investor Conference. My name is Adam Lowensteiner, Vice President at Lytham Partners. Before we begin, for those not familiar with Lytham Partners, it is one of the country's leading investor relations firms. With more than 2 decades of corporate access experience, we have built one of the industry's most diverse and effective platforms for connecting small cap companies with high quality and focused institutional investors, while creating a framework of best practices in all aspects of investor relations. Today's discussion is hopefully yet another example where we could bring value to multiple constituents. We'll dive into the discussion in a moment, but one final item, I want to remind everybody that there are management teams of participating companies today that are available for one-on-one meetings. If you've not already signed up, please feel free to send me an email at lowensteiner@lythampartners.com or visit www.lythampartners.com/virtual and click the one-on-one meeting request button. During this fireside chat, which is titled The REIT Stuff, a discussion about investing in REITs, we welcome Mr. Samuel Wald, Portfolio Manager in the Equity Division of Fidelity Investments. Sam has been with Fidelity since 1996 and manages several real estate REIT equity portfolios that are offered in various investment vehicles. And Sam is also a CFA charter holder. Welcome, Sam.
Thank you very much, Adam. Thank you so much for having me.
My pleasure. Before we begin with the formal discussion, Sam, could you introduce yourself and provide a brief description about your background? How did you make your way to real estate and REITs?
Sure. So as Adam said, I've been at Fidelity for a bit over 27 years now. I was randomly assigned to the group when I first started out of college, and I fell in love with real estate. There was just a lot about the sector that I found to be very interesting, and I continued to learn and grow as I've been covering the sector for the last almost 3 decades.
Great, thank you for that. And now let's dive into some discussion here. Moving to slide 3 here. From your vantage point, what's the state of the REIT environment right now?
So I feel that the REIT environment is really good. And with my answer, I want to start with a little bit of context. So REITs were established by Congress in 1960 as a way to allow individual investors to invest in real estate without having huge sums of money. In other words, almost like a mutual fund for real estate. So as you can see on the table on the left here, commercial real estate is a huge asset class, and allowing individual investors to invest in with relatively small dollar numbers, and also achieving 1, diversification of assets and geographies, 2, liquidity, and 3, professional management was all part of the goal of the REIT vehicle. So as you can see on the chart on the right here, the number of equity REITs and the market cap of the industry has continued to grow over long periods of time here. And so I feel that the REIT vehicle, the creation of the REIT asset class, has been successful in that it's allowed individual investors increasing liquidity and access to be able to invest in commercial real estate. Now, what I want to do, though, is I want to delve a little bit deeper into that question, because I think implied in there is a little bit about what's going on in the REIT market today. So in the shorter term, the stocks have been a little bit weak, and I can give you a whole bunch of different reasons why that might be the case. One of them might be that the economy is slowing in general, and people are looking to other places in the market. Another issue could be that people are nervous about the short-term rise in interest rates, and we can speak about that a little bit more later, Adam, if you'd like. But one thing that I do want to point out is that there are tons of headlines in the media about all the things that are going wrong in the office space right now. And I want to emphasize that REITs is not all office. There's a ton of different types of investments available to commercial real estate investors. In fact, office REITs now make up only about 5% of our benchmark. And there's plenty of other property types that are available to invest in where the fundamentals are much better. such as self-storage properties, data centers, apartments, single-family rental, etc.
Great, thank you. Next question is, in your opinion, should investors have some exposure to REITs and why?
Great, thank you. So there is definitely a basis to have a reasonable exposure to commercial real estate. I've read numerous articles that advocate for allocations to commercial real estate of being anywhere between 5 and 20%, let's say, of a well-balanced portfolio, with some allocation of that being towards REITs. And that's a broader conversation, but I've read anywhere between a third and 2/3 of that commercial real estate exposure can be allocated to REITs. And then I think that later in the conversation, we were going to discuss what some of the benefits of the REIT vehicle or exposure to commercial real estate are. And so we've put together this slide to help address that. So the first thing I want to talk about quickly is the diversification. REITs have a low correlation historically with the broader markets, so they can help diversify a portfolio. Second is income. REITs have historically had above market average dividend yields, and so that can return cash to shareholders sooner. The third would be inflation protection. Real estate is a hard asset, which provides a natural hedge during periods of high inflation or low inflation. Fourth would be that the performance, real estate REITs specifically have historically outperformed other property types, other major asset classes over longer periods of time. 5 is liquidity. There's daily liquidity in the equity markets. So, for example, if I were to invest in an apartment building, it might take me a lot of time and a lot of cost if I wanted to sell that building to achieve liquidity. Whereas in the REIT market, those are traded on the various exchanges every day, and an investor can realize liquidity almost instantaneously. And then finally, transparency. A lot of times when people invest in real estate partnerships, you will get a K1 at the end of the year or something like that, but there isn't a lot of transparency as to what's going on kind of behind the details. With REITs, you get tax transparency, you get transparency, real-time pricing from the market, as well as the strong corporate governance that the public markets dictate as necessary for the companies.
So you mentioned before that not all REITs are created equal. Some have become very specialized in what they're focused on in the real estate market. It seems like we're seeing more property-specific REITs. Is that the case? Are you seeing that as well?
Yeah, absolutely. So REITs have continued to evolve, just like the equity markets and all markets continue to evolve. The real estate markets in public form, meaning the REIT markets, have continued to evolve as well. So if you look back at the graphic here on the left, going back to around 2000, the over almost 70% of the index was comprised of kind of the traditional 4 property types. We joke around and call them the traditional 4 food groups of office, industrial, retail, and residential. And that was the majority of what's been available. That was what was available in the public markets to invest in. As the markets have continued to evolve and as new sectors have become more institutionally acceptable, that's been accepted more into the public markets. And as you can see, there's a snapshot here on the pie chart on the right, where we can see that those traditional 4 categories now represent less than 50%. And we have larger exposures, larger weightings from some newer property types to the public REIT vehicle, including infrastructure, which would include cell towers, data centers, self-storage, healthcare, which includes a whole different subset of asset classes, lodging, and many other sectors.
When you conduct your research in REITs, what are some of the metrics you're looking for to measure success?
Okay, so that's a great question, Adam. Thank you very much. So there's obviously a lot of different things that we look at when we're evaluating companies, and a lot of things that we think about on a day-to-day basis. To not sit here and talk for hours about it, I'm going to try to be a little bit concise and talk about one aspect of it. An important part of our philosophy is that we think about REITs as both being real estate and as stocks, and we analyze them and respect them from both of those perspectives. So what do I mean by that? So let's talk about the stock aspect for a moment. So when we're evaluating a REIT and when we're thinking about a REIT, we think about it just like we would if we were evaluating any other company like Coca-Cola or Microsoft. We think about what the earnings growth is going to of the company is going to be. We think about what the equivalent of our equivalent of a PE ratio, which would be a price to FFO ratio, would look like. We look at various different yield metrics. We build financial models, including income statements, balance sheets, and statements of cash flow. And we try to take advantage of dislocations in the market, just like we would on any other type of equity. But also looking at it from the real estate side, we look at things very much from the underlying supply and demand of that particular property type in that particular location. We speak to commercial real estate brokers about the different geographies and different property types. We look at tenant credits, and we focus on the value of the underlying buildings that are within. And so, that's part of where the art comes to mix with the science, is that there's lots and lots of research we can do, but it all kind of comes together in different ways to help us find the best portfolio of stocks for our investors.
Becoming a little bit more granular now, the Fed has quickly raised interest rates in a very short time frame. How's that affecting the REIT market, and how should investors handicap that when investing for the future?
Okay, great. Thank you for pulling up this slide, Adam. So a very popular misconception is that REITs follow rates, and that's it. That's the only thing you need to look at to figure out what's going on in the REIT market. If you look at this chart right here, you can actually see that the long-term correlation between 10-year Treasury yield and REIT performance is actually virtually zero, meaning that those are not correlated at all. And this obviously is a little bit surprising based on how the market has been acting recently. Recently, there's been a lot of knee-jerk reaction. The rates spike up and REITs tend to underperform, or the REITs kind of drop down and REITs tend to have a stronger period in the market. But what I want to point out is that those tend to normalize after the normal knee-jerk initial reaction, and longer term, they tend to not have very much impact on the performance. That has changed a little bit recently. You can see over the last handful of years, there has been a little bit more correlation, and that has tended in that direction. But over longer periods of time, there is no correlation. So what I thought I would do would be to spend a minute talking about why it would make sense that REITs wouldn't be correlated, because, as I mentioned, this isn't necessarily intuitive. So if you were to think about the different reasons why interest rates can go up, there's, different reasons. One would be that people are just want higher rates in the market at that time. Perhaps animal spirits are wanting more growth, and so the treasuries go out of favor or something like that, and yields go up for that reason. So when that tends to happen, REITs do tend to underperform. But if you think about the other reason that rates could go up, would be because there's stronger GDP growth, more fear of inflation, things like that. And if that's what's going on, then in that environment, that's actually a good environment for REITs and a good environment for real estate. The reason for that is, as I mentioned earlier, one, real estate is a hard asset, and since it's a hard asset, it does have attributes of being an inflation hedge. And second of all, to get granular, when people are thinking about real estate, they'll often think that as rates go up, if you think about a REIT as a series of discounted cash flows, the denominator would go up, making the cash flows worth less, But at the same time, because there's inflation, the rents that the REITs are collecting also goes up, so the numerator goes up. And so net, that actually ends up being a positive thing for the present value of the companies often.
So I'm going to share a graphic now. It seems like it's a very interesting chart, and possibly positive reason to feel a bit risk averse, as other public companies that are carrying debt is tied to variable rates now paying obviously much more interest. Would you like to opine on this graphic, and and if it's beneficial?
Sure, great, thank you, and thank you for pulling this this graphic together, Adam. There's a lot of stuff going on here, and so in order to answer it, I thought I might break some of the individual components out, so we can look at different aspects of thinking about how the rising interest rates will impact the REITs specifically. As you can see here on this slide, the chart on the left shows the debt to total assets of the REITs. And you can see that as time has gone on, the REITs have delevered their balance sheets. Their debt to net assets has gone down. The companies generally have learned from the various crises over time and just carried less leverage on an enterprise value. Second, if you look at the chart on the right, that shows the weighted average term to maturity of all of the equity REITs, and you can see that the managements have actually. So just to clarify what this chart shows, as the blue line goes up here, the average tenure, the average term of the debt has gone up, and as the blue line goes down, the term has gone down. You can see here that the REIT management teams have actually done a pretty good job of, when debt was more expensive and less accessible during the global financial crisis, they tended to go a bit shorter in terms of their maturity and take advantage of the less expensive debt, of the less expensive shorter end of the curve. Whereas in anticipation of potentially rising rates, since then they've steadily increased the term to maturity, which helps insulate the cash flows from rising rates, meaning that it takes longer for each piece of debt to come to market, where the REIT would have to refinance at a higher interest rate. Adam, if you could flip to the next slide, please. I have two more slides which further explain and further clarify the answer to how we think about this question. So if you look at the chart on the left here, so the light blue shows floating rate debt as a percentage of the REIT's total debt, and the darker blue at the bottom shows the average fixed rate debt. And as you can see here, over time, REITs have steadily been increasing their exposure to fixed rate debt to reduce their exposure to the type of environment that we're seeing now with a sharp increase in interest rates. They've been taking advantage of the lower rates for a long period of time and fixing in as much of their balance sheet. And that's also represented or seen in the chart on the right, where over time REITs have steadily decreased their cost of debt, the average interest rate that they're paying. A part of that is that the public markets have gotten increasingly comfortable with the REIT vehicle and the stability of owning a REIT. And part of that is also just that interest rates that REITs have secured and lengthened the term of their duration of their balance sheets while interest rates were advantageous.
Great, thank you, Sam. Before we conclude, any parting words? Is there something that I should have asked that I didn't ask, or is there something that you'd like to share with investors out there?
Yeah, thank you, Adam, for giving me my little open mic at the end here. So I think that the message that I want to leave with investors from this interview, from this presentation, is just that REITs are an important part of any well-diversified portfolio. They should be part of a commercial real estate allocation, and that they provide a lot of different attributes for investors that we referenced earlier, including diversification, inflation hedge, current income. There's just a lot of benefits to owning REITs, and they should be an important part of any well-balanced portfolio.
Great. Thank you, Sam. I want to personally thank you, for taking the time out and having this discussion, as well as to our listeners. If there's any investors that would like to get in touch with our panelists, please feel free to reach out to myself or any members of the Lytham Partners team. Thanks again, Sam, and everybody have a great day.
Thank you very much.